Later in the year, Citigroup jumped on the bandwagon, wrote a report called Disruptive Innovation, 10 Things to Stop and Think About. This was across all sectors. One of those 10 things was solar. Then just last month, McKinsey, through the McKinsey Global Quarterly, published an article called The Disruptive Potential of Solar Power. Robert, I didn't plan that, I swear. Okay, so the question here is what does that disruption really mean? When we're talking about solar disrupting something, what are we actually talking about, and what are we supposed to make of that? So I've been doing a fair bit of thinking about that, and I want to share with you this morning some of the early thoughts that we have about what it really means for solar to be a disruptive force. Here's the first, I think, really key point. Solar is not a disruptive technology. Solar is renewable, but so is wind, so is biomass, so is hydro, arguably so is nuclear, depending on your definition. Solar can be distributed, but cogeneration can be distributed, fuel cells can be distributed, diesel can be distributed. There's nothing inherent about solar technology that makes it disruptive. And I think this is no surprise to people who study disruptive theory in general, which is that very few technologies are in and of themselves disruptive. What makes them disruptive is the business models through which they are deployed, the ways that they are financed, the ways that they are owned, the ways that they are structured in the market that cause disruption. I think this is true of solar as well. It's only the means through which solar is being deployed and could be deployed that causes real disruption. As we were thinking about it, we ended up sort of classifying the disruptive potential of solar into two separate types of disruption, and I'll run through each of those here this morning. The first is wholesale disruption. Wholesale disruption, I think, is particularly interesting because it is a reality today in Europe, particularly in Germany. So let's walk through what has happened and where we stand today in Germany and the disruptive effects that solar has had there, and then look at what impact that might have on the US. So here's the story for what happened in Europe. First, Europe installed a lot of solar. Cumulatively, through 2013, 85 gigawatts or so of solar installed throughout Europe. Of that 85 gigawatts, nearly 40 gigawatts in Germany alone. Much of that 40 gigawatts came online in the last 5 years. If you think about that relative to the size of Europe's electricity markets, which in Germany in particular is smaller than the US by a fair margin, 40 gigawatts online is a lot. That's as compared to 12 gigawatts in the US during the same time period. So you install a lot of solar. Well, what does that do? In Europe, the solar is feeding into wholesale electricity markets. It's on the utility side of the meter. So as it's feeding into the wholesale markets, it has very low operating cost, and it bids in first. And as a result, wholesale power prices started to fall. This was a result of all the solar on the grid as well as a lot of wind coming online as well. So what we've seen over the past few years is wholesale electricity prices on spot falling precipitously since about 2011 through to today, and they've fallen a lot, more than was expected by most people in the market, and a lot of that is driven by the solar that is bidding in first into wholesale spot markets. So what does that do then? Well, if you are an operator of a fossil fuel plant, if you're an operator of a plant that is otherwise going to be bidding into these projects that does have some marginal operating cost, then this is no good for you. And you can see this through what's called the clean spark spread, which is basically a way to represent the gross margin for a natural gas plant operating in Germany. So as you can see, where gross margins were positive, they are now negative. This means if you're operating your average natural gas plant in Germany today, you are losing money. and this is not where you want to be. Who owns these natural gas plants? For the most part, it's the big European utilities. And so they have had to mothball a lot of gas capacity. In fact, in 2013 alone, European utilities announced the closure of over 20 gigawatts of natural gas capacity. Apart from that, they've had to write down all of these assets. Over the past 3 years, European utilities wrote down 23 billion euros in generating assets. This is financial pain of a kind that they have never experienced before, and it's been reflected then in their share prices, which have also been plummeting. Over the past 5 years, the top 5 largest European utilities have lost between 13 and 42% of their share prices. This is as compared to any European stock index, which has been up over that period, and it's particularly painful if you're a utility where your stock price is generally a little bit more stable than the market at large. So this is real, meaningful pain that European utilities are feeling, and then it gets worse when The Economist writes articles like European Utilities, How to Lose $500 billion. It's serious for them, and many of them are asking really fundamental, basic questions about their business models. They're looking at entirely new ways to make money. They're trying to figure out how they can survive. RWE in particular, which as you can see has been losing more money than anybody else, is pretty openly stating that they need a fundamental transformation of their business as a result of what's been happening. So before we go too far, it's worth noting that solar is not the only contributor to what's been happening in Europe. Wind is also a contributor, and so those two together make all of these things worse for utilities. In addition to that, utilities overinvested in natural gas assets. They should never have built out as much as they did in the first place. We have a relatively prolonged economic recession, which has kept demand relatively low, and stubbornly high natural gas prices despite the shale gas boom in the US. So solar is not alone in causing this disruption, but it is a major source of this disruption. And in this case, I think we really can say that it is disruptive. This has changed the fundamental nature of electricity generation in Europe. In the US, we don't have the same thing yet. We don't have nearly as much solar or wind online. First of all, in absolute terms, we don't have nearly as much online, but we especially don't have nearly as much online in comparison to the size of the electricity market. So we haven't seen the same kind of thing happen. What we have started to see, though, a little bit, is wholesale spot prices getting bid down as a result of primarily a lot of solar online. There was a day last month in March in California where wholesale spot prices went negative. They went to negative $70 a megawatt hour for about an hour at the hub that feeds San Francisco due to higher than expected generation from both solar and wind that day. So I don't mean to imply that the US is heading toward where Europe already is, but we are starting to get to the point where spot prices on the wholesale markets are impacted by the solar that's online. That said, on the wholesale side of the meter, we have a completely different type of disruption that is generating a lot of attention right now, and it all has to do with the duck chart. So the duck chart, I'm sure many of you have seen, but in case you haven't, this was a chart that was created by the California ISO, Independent System Operator. And I'll explain what it represents in just a second, but before I do that, I should get this out of the way. I'm not a particularly visual person, and so when I first saw this and everybody started calling it the duck chart, it was like a magic eye painting where I was looking at it trying to find the duck. So we're fortunate at Green Tech Media to have a fantastic set of graphic designers who could show me why it's supposed to look like a duck. Now you know why it's called the duck chart. What the duck chart represents is net load on a theoretical day in California. Net load is the load, the demand from customers altogether that needs to be met by dispatchable resources, meaning basically fossil fuels at this point. So it's taking all of the demand minus production from non-dispatchable resources, solar and wind. And it goes from the beginning of the day to the end of the day. This is a theoretical March day or spring day in which you don't use a lot of air conditioning yet, and so load isn't as high, and at the same time, you start to see a lot more solar generation because the sun is out. Now, the top lines here, the duck's back, so to speak, those are 2013, 2012, 2014. This is now. And then the Cal ISO created this chart primarily to show the duck's increasingly fat belly. which is representing further and further into the future. The reason that this is a concern for the CAISO is twofold. First of all, you have a potential problem in the middle of the day where you can see that they put this potential overgeneration issue. So this is when solar is generating the most. The more and more you put online, the less net load there is, and the further you get down toward what's supposed to be the minimum load at any given point in time. All those base load resources are hard to turn on and off, they're expensive. So if you get down below whatever the minimum is supposed to be, you have a potential overgeneration issue. I think this is a smaller issue compared to the second concern that the CAISO raised, which comes in the evening. When everybody comes home, they turn on their lights, they turn on their dishwasher, load goes up a lot, this is when you hit peak, and it's also when the sun goes down. And so you have a need, as the CAISO would put it, for a lot of fast ramping generation to go from the duck's belly to the duck's, I guess, back of the neck in a very short period of time, and it becomes increasingly steep, which is a big concern for them. Now, the ISO seems to think that the primary solution to this is going to have to be a lot of fast ramping natural gas. And so their argument is we need a lot more of this stuff because we're putting so much solar online. There's a counter-argument to this, which I think is a pretty reasonable one, which is that you can flatten the duck through a combination of other things, a combination of real-time pricing signals, demand response, energy storage, and a number of other things that can manage how this, I guess, make the duck, put the duck on a diet so that you don't nearly see the same level of either overgeneration or the need for fast ramping at the end of the day. The point that I would make here is not to say that either one of those two things is right, but clearly, either way, and I don't think that there's a lot of disagreement about this, the amount of solar that we are putting on the grid in California, so this isn't true everywhere, is already having something of a disruptive impact, or will soon have something of a disruptive impact on how generation looks, especially on days like this in California. So whether it results in a build out of a whole bunch more natural gas, fast ramping capacity, or whether it ushers in a new era of demand response and energy storage and other advanced technologies that manage this load curve, solar is having a big impact beyond just providing generation. And it's real. I think that, this is a theoretical chart, but this is a real day. This is from March 18th of this year. The CAISO is friendly enough to actually put this online every day so you can track the. As far as the curve goes, we are already getting there, I think a little bit faster even than the duck chart shows. So that's a different kind of wholesale disruption, arguably, potentially a good kind of wholesale disruption, because if it ushers in these things like demand response and energy storage, we might say that's a good thing, but it's disruptive nonetheless. Let's move on to the other kind of disruption. I think this is the one that has been garnering even more attention recently in the US. It's retail disruption. So retail disruption at its most aggressive, you could call the utility death spiral, which is a term that's been thrown a lot in solar recently. The argument for the utility death spiral, in case you don't know it, is basically utilities have a lot of fixed costs that they've invested in infrastructure. They're expecting to recover those fixed costs through rates over, say, a 30-year period. So they're going to have to keep rates stable or increasing during that time. But a lot of customers are installing their own generation, reducing their load. Utilities then have to spread those fixed costs off across a smaller number of kilowatt-hour sales, which then raises the price on those sales, which then creates a further incentive to install your own generation. And therein lies the spiral that eventually kills the utility. So let's begin with a reality check on that one. Here's how much distributed solar we've been installing in the US. In the residential market in 2013, we hit up to 800 megawatts. We installed 800 megawatts of residential solar in the US last year. That's an impressive number, especially if you look at the historical trend. We've been increasing pretty quickly. Add in non-residential solar, commercial solar, and that's another about 1.1 gigawatts. So we installed about 1.9 gigawatts of distributed solar in the US last year. How big an impact is that having? Well, that 1.9 gigawatts should generate about 2.7 million megawatt hours, accounting for insolation across different places where it was installed, which accounts for about 0.04% of national electricity demand. Hardly disruptive, hardly ushering in a utility death spiral. But, you might say, the US solar market is very concentrated, right? There are a few key states where most of the installations take place. In fact, in the distributed solar market, the top 7 states in 2013 accounted for 88% of all installations that took place. So you might point out 0.04% of national electricity demand, fine, but what about in those key states? Well, let's look at those states. They are Hawaii, California, New Jersey, Massachusetts, Arizona, and New York, Arizona, and Colorado. Not in that order, but you'll see in just a minute why I placed it in the order that I did. Here's how much solar was installed in each of those states in 2013. This is distributed solar again, so just residential plus commercial, not accounting for anything on the utility side of the meter. It's a lot, I think, especially by historical standards. You know, we have 4 states plus California that installed over 100 megawatts of DG in 2013. That's impressive and something to be lauded. California installed 700 megawatts of distributed solar last year. That's a huge number. But if we put in the context of total electricity sales that year in those states, it's still not very impressive, with the potential exception of Hawaii. And as you'll see throughout this analysis, Hawaii is going to remain an exception in a manner such that if you work for a Hawaiian utility, I would be terrified. Everywhere else, we're talking about pretty low numbers here. We're talking about less than 0.5%, right? So all the distributed generation online, all the generation it's creating, less than 0.5% of total electricity sales. Again, hardly disruptive, hardly making a good argument for a utility death spiral. But now you might point out that it might be the wrong thing to do to look at total electricity generation, right? Maybe we should be looking at load growth. So first, a little bit of context on that. Utilities historically have made a lot of their money built off of load growth. Utilities earn a regulated rate of return on their capital expenditures. Their capital expenditures, some of them are due to upgrades on aging infrastructure and things like that. Some of it has also historically been in preparation for load growth, under the expectation that customers will have more demand for energy, for electricity, and thus they need to invest and earn a regulated rate of return on that investment. That has been one of the central tenets of the way the utilities make money. But already, the rate of load growth utilities are experiencing has been relatively steadily decreasing for about 50 years now. Back in the 1950s, you were seeing more than 10% annual load growth in the US. That's a huge number compared to the past decade or so, where we're more in the range of about 1% annually. The EIA expects that that is going to remain relatively consistent for the next 30 years, so we'll continue to see something like 1% annual load growth spread out across the country for utilities. So already, even prior to any impacts of distributed generation, utilities who are very cognizant of this fact are facing somewhat anemic demand growth and having to figure out how they can continue to make as much money as possible in that environment. So now let's look at the impact of all this distributed generation that came online in those 7 states relative to expected load growth. First of all, let's look at those states in terms of recent historical load growth. So 1% annually, just about, 1.1% over the past 15 years. The states that we're looking at here, more or less representative of the whole. We're talking about a little under 1%, a little over 1% for the past 15 years. Again, Hawaii being an exception. Again, I wouldn't work for a Hawaiian utility right now. So they've been facing slow load growth anyway, but everywhere else, something like 1% per year. So more or less representative of the whole. So let's assume that before we take into account distributed generation and all this solar that's going to come online, that utilities would otherwise have seen a similar level of annual demand growth for the next few years that they have for the last 15. That's actually a relatively generous assumption. Broadly speaking, across the board, utilities are expecting less load growth moving forward than they have been seeing historically, but let's give them the benefit of the doubt and assume these same rates for the next few years. And let's look at 2013. So what we're looking at now is all the DG that just came online in 2013 relative to what load growth would otherwise have been in that same year. And here the numbers actually get kind of impressive. Again, let's set aside Hawaii as a completely unique case, but even in California, New Jersey, Massachusetts, you can see that the generation from all that distributed solar, all that rooftop solar, takes almost a 50% bite out of what load growth utilities otherwise would have seen. That is meaningful. That's relatively disruptive already. Now let's build that forward. and not even that far. First of all, let's look at what our expectation is for growth in these markets over the next few years so you have a sense of where we're coming from. So again, here's how much distributed solar was installed in each of those states in 2013. Here's how much we expect to be installed in each of those states in 2016. We're talking about 2 years from now. And this is the annual growth rate that represents. It's actually, I don't think, a particularly aggressive forecast. Our forecasts for the US solar market, particularly in DG, have been pretty accurate historically and are definitely on the more conservative side relative to what most people tend to expect for growth in the US. So we're talking about annual growth in most of these markets for DG of somewhere between 20 and 60% on the high end in New York, coming from a much smaller base. California will remain the biggest, most important market. I don't think anybody's going to argue against that. Hawaii actually won't see nearly as much load growth, which is maybe the one saving, demand growth for solar, which is maybe the one saving grace for Hawaiian utilities. So now let's look at that same thing, impact on 2016 demand growth for utilities, given the 2016 solar installation levels that we anticipate. And here the numbers are even more impressive. In California, you could see negative demand growth for utilities in 2016 due solely to distributed solar. This is not even accounting for anything else that customers could be doing to reduce their load. This is not accounting for new energy efficiency measures or anything else that they might do. Due strictly to distributed solar, you could see negative demand growth in California. Nearly negative demand growth in New Jersey, Massachusetts, and to a lesser extent, New York, Arizona, Colorado. Right? This is, if you're a utility, this is meaningful. This is potentially disruptive. And this is why also, if you're a utility, you are trying very, very hard to figure out what your strategy is around all of this rooftop solar that's coming online. This is why you are doing battle against net metering, if you are. This is why you're investing in distributed generation through unregulated arms, if you are. This is why you're attending these conferences and trying to figure out what's going on in this market, because it is already having a meaningful impact on you. If not on your overall load, then on your load growth. What little load growth you might have otherwise seen. Just to show what that might look like for a utility in California. So this is relative to 2012 through 2016. So here's what, assuming that same level of flat annual demand growth, this is what your growth would have been, about 3.5% by 2016 relative to 2012. So you can plan around that. You can invest around that. That sounds great. This is what it looks like if you add in all of this distributed solar during that time. You end up with more like 0.75% growth, and towards the end of it, you have slightly negative demand growth. If that's the chart that you're looking at and you're a utility, then this is why you take everything in solar so seriously, despite the fact that it's such a small portion of the mix. So that's retail disruption. And that's retail disruption that is happening today in a few select locations. Obviously, we looked at 7 states here, and even of those 7 states, once you got down toward the bottom of it, Colorado, for example, it's not so impressive just yet. But it's easy to see how it can get there over the next few years, and depending on how aggressive you are in your expectations for the solar market over the next few years, you can pretty easily get to a point where you can see relatively widespread disruption across any market that has a significant distributed solar demand landscape. So what are we supposed to make of all this, just to close out? There were a few things that sort of came to my mind when we finished running through this analysis about solar disruption. The first, and I think what I talked about this morning and that I think is often not noted in conversations around solar as a disruptor, is that solar can be disruptive on both sides of the meter. It can be disruptive in wholesale markets from the perspective of needing fast ramping resources or overgeneration issues, from the perspective of reducing gross margins for natural gas plants. It can also be disruptive on the retail side, and this is what everybody's more familiar with eating into utility revenues. So solar can simultaneously be disruptive in 2 fashions. What are we supposed to do about it as the solar industry? I think there's a few things that we should be doing about it. The first is just continuing to foster this disruption. Generally speaking, I think all of the ways in which solar is being disruptive are for the most part, a good thing. You know, if at the end of the day, after all of this, we have created a market that has a lot more clean, renewable energy on the grid, that has a lot more customer choice, that potentially has smarter generation and delivery and pricing of electricity, then the disruption that we've created is a good thing. So we need to foster that disruption. We also need to be maintaining an eye toward long-term sustainability, not from an environmental perspective, though that is clearly important too, but from a perspective of the fact that we may be having a disruptive impact today, but we want to have a solar market in 30 years. And so as we're designing market structures, business models, policies, incentives, whatever it may be, we need to be maintaining a long-term eye, not a short-term eye. It's not a focus on building out as much solar in the next 3 years before the ITC expires as possible. And I actually think this is an attitude that the solar industry globally is not great at. In the US, we tend to be a little bit better than the global market at large, but if you look at what's happened in European feed-in tariff markets and feed-in tariffs in even Japan and other places, the focus has been on near-term build-out. We should be focusing on long-term market structure and long-term build-out. And finally, I think I'd be remiss not to mention that as we cause this disruption, we need to be maintaining a strong eye towards equitable growth. The last thing that we want to do in solar is create an energy divide through which you have a lot of customers installing solar, but those customers tend to be the ones that can afford it. This would be even worse if it's all solar plus storage and they're going entirely off the grid, and then you leave all this costly infrastructure to everybody else. There's a similar concept in telecommunications called the digital divide. We don't want that in solar, and so we need to be creating systems to enable anybody, whether they are a homeowner or not, or they have good credit scores or not, to participate in this disruption and not just face it up differently. So with that, thank you very much for your time this morning. I'm really excited to spend a couple of days learning from all of you here, and we're going to head straight into the next panel, which I'm excited to see. It's moderated by our senior editor, Stephen Lacey, and it's about solar in the mainstream. So thank you very much.